In conversation with Sanjay Bahl, he's the group CFO at Raymond. Raymond came out with its numbers yesterday. The revenue was up 12%, EBITDA up almost 33%, margins of almost 11%. So decent showing by Raymond this time around. Thank you, Sanjay, for speaking to BloombergQuint. First of all, if you're looking at it, growth continues to remain slightly muted in the branded fabric business. What is the company's strategy to, grow this business going ahead?
Yeah, so I think we have to see these results against the backdrop of the very challenging business environment that is facing us today, and a few points there. One, of course, is a very weak macroeconomic environment. Second, very subdued consumer buying sentiments which have prevailed through the quarter as well. And the third important point is the liquidity concerns in our trade channels, continue. Now, against these business, environment, we do not see this really changing very dramatically over the next quarters as well. This is the reforms that we are expecting, and we are expecting that there will be certain actions in which will lead to better consumer sentiments as we move forward into the next year. But the revenue growth of 12% is encouraging, therefore, to see. Yes, the core textile segment has seen a growth of 2%, but when we look at between suitings and shirtings, the shirting business has seen a growth of 9% and a 1% really in suitings, which has led to the overall branded textile at 2%. Apparel business has seen strong growth, which is 23%, and the other businesses have also contributed, other than auto, which is going through its cyclical downturn. So against this backdrop, I think it's been a good performance. The focus of our core textile is really not so much on chasing revenue growth, given weak consumer sentiments, but is really chasing really the quality of growth, bringing receivables down, improving cash flows, and protecting margins.
Sanjay, I agree with you that your branded apparel business did extremely well this time around. What's the strategy of growing this business?
So the strategy is, as we have mentioned earlier, the 4 power brands lead our growth strategy. We have extended into the full wardrobe solutions now. We have also launched our ethnic range in the menswear section, ethnic and ceremonial wear. We are ramping that up as we speak. So we've got close to about 10 stores now, 8 to 10 stores, and we are in the process of expanding this nationally. So the strategy is really to grow our brands and also the ethnic range. But we are going to be very selective in terms of growth in the channels. Given the liquidity concerns in the wholesale channels, we will certainly be focusing more on the retail channels as we move forward.
What's your sense on margins going ahead? No doubt you said growth is challenging, but I think operationally you've done well. Your margins have also come up. So on a blended basis, where do you see margin improvement coming in?
So in the textile business, we see improvement coming in because of the channel mix that we are now the revised channel mix that we are looking at with a bigger focus on the retail channels, and the lower input costs and cost efficiencies coming in textiles. So we are seeing improvement in margins there. We've indicated close to about 50 basis points improvement in the next quarter. And if the wool prices sustain over the next year as well, then certainly these margins will be maintained. In the branded apparel business, we have consciously, while the revenue growth has been aggressive, but we are now ensuring that the pipeline inventory correction is also done in the wholesale channel. So we've taken our provisions for liquidation of inventory in Q3, and this will continue in Q4 as well. But margins will, post this correction, once it is done, the margins will improve from the next year, from Q1 of next year.
Give us a sense of the real estate business. Obviously, there was traction that happened there. What's the outlook here?
Well, overall, the sector continues to be weak. However, the product offering that we have, very good numbers to report on that. During the quarter, we have sold around 248 units. And overall, for the project, we are close to 900 units now in terms of sale, with a very high percentage of registrations. So the business is carrying on the momentum of high sales velocity. We launched the 1 BHK as well, and within our existing project, and that has met with a phenomenal response. We've sold 171 apartments in 2 months. So good consumer acceptance of the product, and this is leading to better cash flows for the project as well. It's positive. So all good indications on this project, carrying on, as we move forward.
You've managed to reduce debt by over 400 crores this quarter. Give us a sense of the balance sheet. How is debt looking like, and what's the plan in reducing this even further?
Yeah, so from a peak of around 2,850 crores in September, we brought it down by 415 crores in quarter 3. This, of course, is facilitated by the infusion of 350 crores from the land sale that we had, and the preferential share allotment that we completed in quarter 3. And also free cash flow that we generated in quarter 3. So it's a mix of both. And with our focus on free cash flows, and with low capex now in our plans, we expect that with better working capital and low capex, our free cash flows will continue into the next year, and our debt reduction initiatives will continue. So we're hopeful of bringing this down further. Our interest costs are going to be lower as well. And with next year, we will also be getting tax benefits on account of the lower tax rates that were announced recently.
Okay, Sanjay, my final question. Obviously, you announced the demerger a while back, but just to get a more clarity and sense of how the group is headed in that direction, give us a sense post this demerger. How do you see the group shaping up, and where are the avenues that you see will coming?
So strategically, the entire group will be now segregated into 2 portfolios. One business, which is the Raymond Lifestyle entity, which will be completely focused on the consumer businesses, which is the branded textile and branded apparel and garmenting business, to support these 2 segments. So Raymond Lifestyle will be a pure play consumer business. The existing Raymond Limited will be predominantly a real estate company with the engineering businesses in its fold. So clearly, a clarity in terms of the structure of the businesses. One company completely focused on consumer businesses, the other is on real estate and engineering businesses. So on the operating side, benefits coming in because of lower interest cost on taxation. So clearly, benefits which will help in cash flows there. And each of these businesses will be are expected to be free cash flow and generating entities, and will chart their own future course of growth, and shareholder value will creation.
Okay, Sanjay, we leave it at that. Thanks so much for speaking to BloombergQuint, and all the best for the quarters going ahead.
All right, thank you.